This is fifth and last video of this series. In this video, we will construct our day 1 balance sheet. This is Vilas. Let's get started. This is how our day 0 balance sheet look like. We will divide this balance sheet into two sections. One is asset and another is liabilities and equity. Then we will go through each point in the assets or liabilities and equity and see how it's been impacted by our day 1 operations. So let's get started. This is how our day 0 assets look like. Now we want to understand the impact our first day operations, and then we will create day 1 assets. Let's start with the cash. The cash at the end of day 0 was 15,000. Because of our operations, we generated cash of 1,250. So the cash at the end of day 1 would be 15,000 plus 1,250, that is 16,250. Coming to inventory, the inventory at the end of day 0 was 5,000. During our day operation, we consumed inventory worth 800 rupees. So we will subtract this 800 from 5,000, and at the end of day 1 our closing inventory is 4,200. Coming to utensils, so we calculated that we would be depreciating a utensils worth 14 rupees. So the value of utensils at the end of day 1 would be 10,000 minus 14, which is 9,986. Similarly, we will depreciate our store by 11 rupees. So the value of the store at the end of day 1 would be 20,000 minus 11, that is 19,989. So the big question is, what about receivables? If you remember, on day 1 there were some friends who did not pay us the money. Hence we want to make entry of that money yet to be received, that is receivables, in our balance sheet. Since this is money which business owns, the receivables will fall on the asset sides, and to be precise, on the current asset sides. So let's make an entry for receivables under the current asset side. The receivables at the end of day 0 was 0. To that we add 250 rupees which is yet to be received, and the receivables at the end of day 1 would be 250. Now we have calculated all the current assets and the non-current assets for day 1. Let's add all the current assets. The value of current assets would be 20,700. Similarly, let's add all the non-current assets. The value of non-current assets would be 29,975. If we add these current assets and non-current assets, we will get the value of total assets at the end of day 1 as 50,675. We have calculated our asset side of the balance sheet. Now let's work on the liabilities and equity side. This is how day 0 liabilities and equity side look like. Let's calculate what happens to this after the operations of day 1. We did not take any loan on day 1, neither did we repay any loan on day 1. So the debt at the end of day 1 would be same, that is 25,000. Similarly, we also did not put any money in the business. So our equity, that is owner's money, would be 20,000. Now another question is, where does payables go? Similar to receivables, there were certain cost items which we were expected to pay but we did not pay. Those cost items we call as payables. The payables is the money which business owes. So the entry will go under the liability side, and to be precise, under the current liability side. So let's make an entry of payable under current liabilities. The payables at the end of day 0 was 0. To that we add payables of 399. Hence the payables at the end of day 1 would be 399. Another question is, where does profit go? Before answering this question, we should answer, does the business own this profit? No, the business does not own this profit. The shareholders, as in the owner who had put the money, owns this profit. Hence the profit will go under the liability side, and to be precise, below the equity section. So let's make one entry for profit, and it's typically called as retained earning. Retained earning is the earning which business was expected to pay the owner but it did not pay, and hence it retained it for now. Hence it's called retained earning. Retained earning at the end of day 0 was 0 because we did not start any business operations. To that we will add our profit of 276 at the end of day 1. Hence the retained earnings at the end of day 1 would be 276. Now we have calculated the current liabilities, non-current liabilities and equity. Let's add them up. The current liabilities at the end of day 1 would be 399, non-current liabilities would be 25,000, and the equity would be sum of 25,000 and 276, that is 25,276. If we add this current, non-current and equity, we get total liabilities of 50,675. So if we put assets and liabilities together, this is how they will look. If you notice, the total assets at the end of day 1, which is 50,675, is equal to total liabilities of 50,675. Thus these two numbers, which should always match, do match. This is how our day 0 balance sheet looked like. This is the end of our day 1. We have already created our day 1 profit and loss, cash flow and balance sheet. I would request you to go back and watch earlier videos to get a better understanding. I will be making similar videos in the future, so I would request you to subscribe my channel. This is Vilas. Thank you and have a great life.